Good morning, everybody, and welcome to the second in this IMAP webinar series, where we're focusing on portfolio construction in a scenario which is outside the conventional 60/40 accumulation. So, how do portfolio managers and advisors build portfolios when the objectives are different from the implied objective of a 60/40 portfolio? Yesterday, we looked at retirement, the most obvious example. Today, we're going to look at that emerging issue of responsible investing or ESG-oriented investing. I know from a little participation in the election process that we've just been through that issues of responsible investing, ESG investing, climate change came up quite frequently in the people who were choosing to cast their votes. And you'd expect that sense of this is important and I want my investment portfolio to reflect this will come up increasingly in the way portfolios are constructed. Before I hand over to Daniel Stojanovski, our moderator for the whole series, let me just say a little about the upcoming events for IMAP. Tomorrow, we'll be focusing on portfolio construction when the objectives are participating in the new economy, investing in thematics and alternatives. So for advisors or clients who think that new economy and thematic issues should be part of their portfolio, what impact does that have on the way portfolios are constructed? The IMAP Awards are now open, and I'd encourage those of you who are thinking of participating to get on and register your interest in this. The submissions close on the 23rd of May, and this year we have introduced, in addition to the asset class categories, the licensee or boutique category, the innovation category, and a responsible investing category, we've introduced a retirement category. And then finally, in July, as part of our focus on the process of advice, the things that make advice practices more profitable, more efficient, we'll be running our Advice in Action conference in Sydney and Melbourne. Of course, we encourage you to ask questions, and the Q&A button at the bottom of your screen is the way to do that. So now it's my pleasure to hand over to Daniel Stojanovski, the CIO of Ventura Funds Management, to act as our moderator. Daniel, thanks very much.
Thank you, Toby, and good afternoon, everyone, and welcome to today's session. My name is Daniel Stojanovski. I'm the Chief Investment Officer at Ventura Funds Management, an asset consultant to Centrepoint Alliance, the entire dealer group. And essentially my background around that, for those who don't know me, running portfolios, multi-asset type portfolios as SMAs and managed accounts on various platforms, and obviously providing research to our underlying dealer groups. Now, looking at, and as Toby sort of mentioned from yesterday, what we're really covering, the difficulties of building portfolios in the retirement sort of setting beyond, and looking at the objectives beyond the outside that conventional 60/40. And really what we're doing right now in today's session, I think is quite topical, dear to my heart as well, in terms of having looked at this space really, really early on, and then continuing on, and how the market and how the industry has changed over the course of many years. But looking at the difficulties in constructing portfolios with and for clients with responsible objectives. And I think that's really a really topical sort of area, something that still continues to be a challenge for some advisors, and we've noticed that. And many of the issues come back to data, and then second, being clear about the objectives. And ideally, when we're looking at this, it's really important that we are dealing with portfolios and requirements that are specific to the client, specific to, let's say, organizations like charity organization. So it varies when we're looking at this. I'd just like to introduce firstly, before I sort of just give more of a brief overview in terms of our views, Dianna Enlund from Sustainability Solutions, who is the Sustainability Solutions Director for S&P Global Sustainable. and Mark Jordan, the Senior Business Development Manager at Nanuk Asset Management. And before I hand over to them, what I really wanted to focus on in terms of what, looking at from our perspective, specifically around responsible investing, ESG, how it's changed over the course of the years, but also what we've been noticing from advisors, and it's probably questions that you already have, thoughts that you already have, or you've probably tackled a lot of these things yourselves. First of all is it's very definition based. And what we mean by that is, depending on how you want to approach it for a specific client, it is client specific. Now, we always look at it from a perspective where you're trying to design portfolios, you're trying to design philosophies that is broad based, and it is difficult. So we always start with what is the philosophy? How does that then go into what you're trying to achieve? I think we break it up into two sort of scenarios here. So first of all, you are still trying to achieve an investment objective. I think that's very clear over a specific time frame and time horizon, and that needs to be still factored in. The next step is, okay, well, what are the responsible ESG type objectives we're trying to hit? Now, a lot of it is an education piece for a lot of clients, and some maybe want to participate in those areas, but are not sure how to. And then the next sort of stage of different types of clients, sophistication of those clients is, well, are they charitable organizations? Are they specific to, let's say, cancer research, or, they have businesses that require, I guess, focus or exclusion in certain areas. So this is where process starts to become a bigger question, bigger topic to talk about. I always like to, and we've always approached the viewpoint when we're building portfolios, it's not for everyone, but having exclusionary type strategies and impact type strategies. And what we mean by that is exclusionary is focused on what we want to exclude. Are you excluding tobacco? Are you excluding areas of the market that are probably not that responsible in nature? While impact is, and this is where the education piece is around, that you may have companies that are trying to change their structures over the course of a number of years. Obviously, Rome wasn't built in a day. So impact managers have a very different focus, where they might have non-responsible type companies that they might have, but that are actually changing over time. So that's sort of how we break it down in terms of that education piece. And it's not for everyone. Some clients don't want the impact, some do, and some want exclusion and some don't. Now, where the next sort of stage is, and when we're looking at this, is active versus passive has become a huge sort of talking point with advisors and clients as well. I think with some passive exposures, you can get, from a multi-asset perspective, quite good exclusions, and also quite good, strong SAA and DAA. But then again, active is also very important in portfolios. Now, there are limitations around cyclicality. What was my portfolio made up of? Am I getting pure, am I taking, when we're looking at this, tracking area is huge and a factor to consider. Are we taking in style risk? What type of styles do we have? Do we have too much tech? Don't we have too much tech? That then plays that role of, are you getting a pure exposure from ESG, and are you sort of giving up a number of, I guess, creating cyclical issues or not? Now, there are some of the limitations or questions that come around this. And again, how you approach it will be very client specific. And what we wanted to talk about in this session and really discuss is, what are those questions, what are those difficulties, and how are we constructing things for different clients? So what I might do is now pass it on to Dianna to start her session, and I'll go back to the panel after that. Thank you.
Thank you, Daniel, and thank you for having me on this webinar. So my name is Dianna Enlund. I'm a director at S&P Global Sustainable One. I work with clients on their needs around sustainability and climate data and analytics. In 2024, 88% of Australians expect their super or other investments to be invested responsibly and ethically. Now, this was based on a 2024 survey by RIA, or the Responsible Investment Association Australasia, and the survey was on consumer demand for responsible investing in Australia. This is why it's important for financial advisors to understand a client's sustainability needs and preferences, because more and more we're seeing that the consumer is wanting their investments to be invested sustainably. Next slide, please. Now, before I start, I just wanted to provide a very brief introduction to S&P Global for those who may not be familiar with the S&P Global business. S&P Global is a provider of financial intelligence solutions. We are comprised of 5 core divisions, which you can see on the chart on your far right. And this includes ratings, S&P Dow Jones Indices, market intelligence, commodity insights, and mobility. Now, within each of those divisions, we offer sustainability data, analytics, and solutions, some of which I will be talking about today. These help our customers understand their sustainability risks and opportunities, as well as support their sustainability reporting requirements. In particular, as you may all be aware that this year, mandatory climate-related financial disclosures reporting kicks off for the large Group 1 companies. So we also help our corporates with their sustainability reporting requirements. Next slide, please. So one of the core questions we want to answer today is how to construct portfolios with a sustainability or climate-aware mindset. Today, I'm going to focus on an equity investing lens. And this table illustrates different types of sustainability indices developed by S&P Dow Jones Indices, which can help us in thinking about portfolio construction of sustainability or climate-aware portfolios. I will talk about this more from an index perspective, and I believe Mark will later bring this to life from a portfolio perspective. Now, our sustainability indices are classified across 3 categories that you can see here: sustainability, climate, and thematic sustainability. Now, as Daniel mentioned, a typical starting point is to think about exclusions. And within our sustainability category of indices, we have our sustainability screen category, which really comprises industries with sustainability-based exclusions. So if we're thinking about an Australian-based index, the S&P ASX Fossil Fuel Screened Index is one that just excludes those stocks that do not satisfy the criteria for certain fossil fuel-related business activities. If we want to move beyond just exclusions, we can then start to focus on best performers using a certain sustainability criteria. S&P Global's scored and screen indices categories has a set of exclusions, but also has a cutoff for including securities within each GICS industry group based on their S&P ESG score. So for example, the S&P ASX 200 ESG index will start with a set of exclusions applied to the underlying parent index, the S&P ASX 200 index. These exclusions include thermal coal, tobacco, and controversial weapons, amongst many others. Now, after those exclusions are removed, the index then selects companies in each of the GICS industry group in order of their S&P Global ESG score until the required cutoff is reached. Selecting by industry group ensures that the index maintains an overall similar industry weight as the S&P ASX 200 index. Moving on to our climate indices, they are really designed to address climate change and the transition to a low carbon economy. These include carbon efficient indices, our net zero Paris aligned, and net zero climate transition indice categories. The carbon efficient index really looks to reweight companies within their industry based on their carbon to revenue footprints. So for example, it will overweight or underweight those companies that are lower or higher in their carbon emissions per unit of revenue. Finally, the last category is our thematic sustainability indices, which focus on specific ESG-related issues such as clean energy or water. And these will be more around portfolios that are constructed from a more impact perspective, as Daniel was talking about earlier. So I have just explained some of the approaches to thinking about sustainability portfolio construction from an index construction perspective. The next question is really, what data do we need to construct these types of indices or these types of portfolios? So over the next few slides, I will outline some of the data that can be used, which are also used as inputs in the construction of our sustainability indices. So here, when using an exclusionary or negative screening approach, business involvement data is one of the key data inputs required. At S&P Global, our business involvement screen is split across 4 categories that you can see here: consumer products, energy and fossil fuels, defense and weapons, and healthcare products and services. In total, we cover over 35 products and services across these 4 categories. And under each of these categories, you can see some examples. So under consumer products, we can cover exclusions around gambling, alcohol, tobacco. For energy and fossil fuels, we've got Arctic drilling, nuclear, coal, and many others, which are not shown on this slide. Next slide, please. This dataset covers over 17,000 listed companies and offers 6 types of data insights, which you can see on this slide. But the key analytical data that we use to screen companies is their revenue exposure and significant ownership exposure to controversial products and services under the categories you saw in the previous slide. Next slide, please. So if you want to move beyond exclusions and look at ESG performance, our ESG scores and data can help. Our ESG scores is based on a questionnaire called the Corporate Sustainability Assessment, or CSA, and each year we invite now over 14,000 companies to participate, and this is global. It's very comprehensive. The questionnaire can take a corporate up to 200 man-hours to complete. It's rigorous as well, so the corporates need to upload supporting documentation. So if, for example, if there's a question on your human rights policy, we need to see, an actual attachment of that human rights policy. So based on the information collected, we then generate up to 1,000 data points from which we assess a company. For companies that don't complete the questionnaire, our analysts will use publicly available information to fill in as many questions as possible in order for us to score the company. So each question is scored by our analytical team, which builds up to a question level score, and then that builds up to a criteria level score, and then we have an E, S, and G dimension score, and then finally the overall company ESG score. Next slide, please. Now previous slide. Thank you. This slide shows the 3 dimensions, E, S, and G, as well as some examples of criteria under each dimension that we will assess a company on. The criteria will vary depending on the industry of the company, but all companies in the same industry will be assessed using the same criteria and the same weights for each of these criteria. Now, one of the criticisms of ESG scores and ratings is that they are a black box, and different providers have quite varied scores due to different emphasis across each of these factors. So it is important to understand that ESG comprises many different topics, as you can see on this slide, and this is only a snapshot of all the topics that we cover for ESG. So what happens is different providers may not cover all of the same topics, and they may assign different weights to different topics, and this leads to different ESG scores across providers. So this is really why it's important when you're using an ESG scores provider to really understand what the methodology is and what goes into the ESG score. Now, what distinguishes S&P Global Score is the focus on transparency. So we really have more of a glass box approach. We provide our clients access to data down to the question level. So you can actually see the response the company provided to the question where it is public information. You can see the score and the weight of each question and criteria topic. So if you can see here under environmental, for this particular sector, perhaps biodiversity has a score of 5% and climate strategy 10%. So we're very transparent about how we've weighted the various components. What this means is that by using this data set, you can actually build your own ESG score using the criteria that is important to your client. You merely just vary the, pick the criteria that's important and vary the weight depending on your client's preferences. So, for example, if your client just wants to focus on the best performing companies, having an ESG score over 70 in, say, climate strategy, biodiversity, human rights, and sustainable finance, and assign a 25% weight to each of those, our ESG scores allows you to do that and provides the granular level information to enable you to do this. Next slide, please. So our climate aware benchmarks draws on a range of data sets, and this can include the business involvement screens and ESG scores, which I've just described as inputs, but it also incorporates environmental and climate data and analytics. I will discuss just 2 of these data sets today, just in the interest of time, but there are several more that I just won't have time to cover today. Here, you can see here is the Trucost environmental data set, and it covers over 20,000 listed companies, as well as 3.3 million private companies on a modeled basis. So basically, we have greenhouse gas emissions on an absolute and relative basis for all these companies. The data set also includes metrics around air pollutants, waste disposal, natural resource, water use, and fossil fuel reserves, for example. Next slide, please. For climate indices, we may also incorporate physical risk data. S&P Global's physical risk data sets looks at the location of a company's assets and overlays that with climate hazard maps to form an assessment of a company's climate physical risk exposure across different hazards, such as flooding, drought, or water stress. So on the chart on the left, you can see an analysis of the Australian-based assets of S&P ASX 200 companies. What this shows is the exposure of these assets to various climate hazards in the 2050s decade based on a medium to high climate scenario, which is basically a business as usual scenario where we're not being very active in our actions to mitigate climate change and reduce carbon emissions. You can see that wildfire shown by the red dots, water stress in orange, and pluvial flooding, which is really extreme rainfall and flash floods in purple, are the key impacts expected. This asset level data is then aggregated up to the company level, which you can see on the chart on the right. We can then apply climate scenario analysis to understand a company's exposure across 4 different climate scenarios and across various decadal periods from the 2020s all the way out to the 2090s. So to summarize, we looked at various S&P Dow Jones sustainability indices to understand different ways that you can construct portfolios with a sustainability or climate aware lens. We then reviewed some of the data sets needed for these approaches. I will stop here and hand back to Dan.
Thank you so much, Dianna. And there are a few questions that we could probably tackle later on about this, so it was fantastic. I'll just introduce Mark Jordan from Nanuk now to start his session, and we can get back onto the panel and start answering some of those questions and some of those topical sort of areas that we've got. So Mark, take it away.
Thanks, Daniel. Thanks, Dianna, for that session that you provided there on S&P. I think really interesting and just goes to the depth of data that we're able to get out of your system. Can I just go to the first slide? Thanks, Toby. So one of the challenges really faced in this sector is confusion around some of the terminology. So this headline here on the screen might surprise a few people. It came from the AFR back in November 2023, and understandably it raised some eyebrows. But let me clarify, all is not what it seems. The argument here is not against ESG practices, but against using the term to describe a range of different investing approaches. And we think it's caused confusion and misunderstanding when clients or advisors are looking at different investment options that align with objectives. And we've seen this problem rise over the past few years, and it's caused some investors or advisors to actually shy away completely from the responsible or ESG investment sector. The majority of asset managers have implemented an awareness or integration of ESG risk as part of their investment or risk management policy. And so they should. Companies demonstrating a negative impact on the environment, so energy use, energy efficiency, pollution, emissions, climate change, etc., or the S, the social, so poor labour practices, human rights issues, community relationships, or the G, the governance, business ethics or integrity, poor disclosure, not acting in the interest of shareholders, and we've seen a few of those cases more recently. These businesses, if they are having a negative impact, they are putting at risk the future cash flows of their business, and that can materially affect portfolio outcomes over the long term. So I think most investors, and Dianna quoted a number of 88% of investors having a view on this, they have an expectation that investment management teams are considering these risks. And it's no longer considered a fad or a niche or even moral grandstanding as perhaps it may have in the past to have this as part of your investment process. So the way we think about it is the focus really should be on what a fund does invest in and not necessarily about what their ESG policy informs them not to invest in. What is the investment strategy? And when it comes to managed funds, this is where the ESG acronym has become probably, you can use the term overloaded. It means different things to different people, from exclusions to ethical screening to risk management and active ownership. We sort of think about the way the term has been used, a little bit like using the term alternatives to describe a broad and diverse range of investment strategies. So, alternatives might include hedge funds, property, credit, infrastructure, fixed income, and so on. It tells us very little about what the investment strategy is. So when someone mentions the term alternative, there's more questions. So what are you talking about? Are you, in credit? Are you in hedge fund? What's the strategy? And I think that same thing needs to really take place when we're talking about ESG or responsible investment. So shifting the focus away from labels and scores and to Dianna's presentation, the scores are a great place to start to filter, but I think we need to take it further than that and really look at what's driving long-term value and risk in a portfolio. Next slide, thanks, Toby. So to do that, we need to consider the strategy of each individual fund. So there are roughly 600, that's right, 600 different ESG standards and frameworks that are being used globally. And the vast majority of those could be categorized into the 7 categories shown on this table. So we've got negative screening, so that is excluding bad companies. Favouring companies with good governance, that are achieving better than average or more positive governance outcomes. Active ownership and engagement, so companies that are or funds that are encouraging companies to improve their governance or sustainability. The next one there, investing in companies that are helping to improve sustainability, and that's a feature of what we do at Nanuk. Then we have low carbon emissions exposure, and the next one there, a focus on decarbonisation, and those two are different. And lastly, impact investing that brings with it some measurable outcomes. So there's 7 different ways of investing in that framework, and they are all referred to as ESG investment, but clearly 7 different strategies. In many cases, they can be and are effectively combined, but they don't need to be. And they aren't entirely compatible either. So you can't do all of these things well at the same time. For example, one strategy might invest in businesses with low carbon emissions, while another ESG strategy might invest in high emitters or oil and gas companies and seek through engaging with those businesses to lower emissions and become more sustainable. So very, very different strategies. So it should be obvious that the term ESG, or for that matter, even responsible investment, should not necessarily be used to represent a single concept, because it doesn't. Investor confusion really arises not so much from the strategy, but more about a mismatch between what a client expects and what a fund actually does. So really critical to make sure there's an alignment between the client's personal goals and the fund's stated investment process. Just on to the next slide. Thanks, Toby. So it shouldn't come as any surprise. I'm going to just talk very quickly about what we do at Nanuk, just to provide an example of a specific approach. So we look at responsible investment, and it's effectively inherent in our investment philosophy, and our focus on investing in industries and tech that are contributing to or benefiting from the global transition towards greater environmental sustainability and resource efficiency. So we're looking at companies involved in these 9 areas of sustainability. Look, I won't go through them all in detail, but we have energy, we have industry, transport, cities and infrastructure, business and economy, food and agriculture, consumption, healthcare, and the environment. So all of our businesses are involved in sustainability around those areas. An important point to make here is that fundamental company research, which is what we do, provides much deeper insights into the companies to ensure that there aren't hidden or unintended risks or exposures in the portfolio. So often simple scoring or quant filters may miss details that are important to some investors. So a good example of this is the Chinese EV manufacturer, BYD. So electric vehicles, there's certainly a sustainability aspect to that. BYD scores reasonably well on several ESG related metrics, but most people wouldn't know that they also have a subsidiary business that manufactures e-cigarettes or vapes. Whilst perhaps not financially material, and noting that they recently flagged an exit to this business, it's certainly something that I think would be concerning for many investors that had a view in this space. So a fund investment strategy needs to be clear and credible. Ideology alone won't provide the investment returns demanded by investors. So you need to have a process that can identify long-term value creation to drive the outcomes. Just on to the next one. Thanks, Toby. And apologies, most people probably may not be able to read all the fine print on this slide, and it's certainly not. I'm not going to go through it line by line. This is an example of our ESG exclusion framework. And whilst this is perhaps more comprehensive than some other funds, this in itself is not a significant source of difference. As I mentioned, there are many managers with a similar framework, and it does remove risks from the portfolio, but the real value comes from the investment strategy and the stock inclusion process. Just on to the next one. Thanks, Toby. So how can advisors generate discussion with clients to try and bridge this gap between investor objectives and the different fund approaches? So the table on this slide is a slight modification of the slide shown earlier, and it contains some plain language descriptions that we think are more relevant to understanding what it is that clients want to achieve with their investment, or how they want to align their investment and their values and beliefs. Hopefully this is something that's helpful. It's not rocket science. I think, thinking about how an advisor engages with a client, as a framework, firstly start with client values. And I'm sure many are already doing this. Asking questions: are there social or environmental causes you care about? Are there industries you want to avoid? Do you want to invest in companies that are making a difference to certain outcomes? And then, comes the education process. And I think this was mentioned earlier. Just educating the client on the spectrum of investments in the space, and what's contained on that table may assist. Explaining how funds implement their strategies. Are they, exclusionary screening? Are they positive inclusion? What is the process? And then I think also clearly you need to show evidence through reporting that demonstrates there's an alignment there. And as with any investment, that review process is critical on a regular basis, sitting down and making sure that the investment strategy still aligns with the client's values and goals. It's not a one-off conversation. So I think a simple approach to be clear on what each fund and strategy is trying to achieve, and getting alignment with what clients are looking for in their portfolios that meets their goals and objectives. With that, I'll hand back to Daniel. Thanks.
Thank you so much, Mark. That was great, and there is a few questions, so I might sort of start the panel with some of those questions, and I think there's a broad one here, and I'll sort of tackle it first, and then see what Mark, Dianna, your thoughts around this. But there was a question, and let me just click it live. So, why would a client pick their own ESG scores if ESG investing delivers higher returns? How are those two positions consistent? Now, from my point of view, in terms of looking at it from an advisor's sort of what we've sort of seen in the past, I have a good friend who's an advisor who obviously does a lot of work with charitable organizations, philanthropic organizations. And the viewpoint is there are some clients that will have very specific requirements, and they might want to go, or there might be a committee, for example, that is instructing that, and might have scoring that they want included. That's how we've seen it used in the past. And then obviously the next sort of stage on that is, how do I develop something around that, a portfolio, a solution, factoring in some of those scores, or having that, from a perspective that the client may have more sophisticated viewpoint in this area. That's sort of how we've seen it. And again, then it sort of flows on to the advisor and the investment team. Well, how are we going to deliver that? What are the investment objectives? And essentially, what are the responsible objectives that obviously we know of and can build around? I just might open it up to Mark or Dianna, what you might have sort of seen on that basis.
That one might be better for Dianna to kick off.
Yeah.
Yes. Yes, I mean, I totally agree with your comments, Daniel. I mean, we've seen, I think it helps if a client have their own specific ESG objectives or views. So as you can see in the ESG data set, there was just so many different items, and sometimes the impact gets reduced if you really want to focus on climate. But you can see under environmental, we had water and we had climate, and we had so many different factors. But if you really just wanted to focus on one area and find the companies that are doing the best in that area, our ESG scores, because they cover so many different areas, the real impact of what you might be looking for as a client will get filtered out. So a client might decide to just focus on a particular area and build, use data to build their own scores or, screens, for example, to ensure that they meet their own specific objectives.
Right.
Mark, do you have any comments?
Oh, look, the only thing I would add there's some, every investor is going to be slightly different as to what they want and don't want. As an advisor, obviously, you've got to be careful that you're sort of meeting the objectives of the client without going overboard. There's a whole range of different managed funds, different strategies out there in the marketplace available, and I think there will be further in time, further different strategies will come that will probably satisfy the needs of the majority of investors. So clearly going down the path of building completely bespoke direct equity portfolios with clients is admirable, but I think it's not particularly efficient.
And Mark, just something for you sort of to start some of the other conversations with is just a question around, okay, you run a global equity fund. How do you see it fitting into the broader global equity strategy? I think that's, and sleeve, I think that's probably the big question to be asked when building portfolios. And you as a manager, sort of, how do you sort of fit into that? And what do you displace? I think is a big question around that.
Yeah, look, what we displace is, I'm not going to sort of go too far into that specifically, but we sort of see two different streams. I think you can sort of break it down simplistically into two different types of portfolio. The first is that broad unconstrained portfolio. It may not necessarily have a responsible or ESG focus, and then you obviously have that responsible investment portfolio that is more common. So in that broad portfolio, that unconstrained portfolio, we typically see a fund like ours sitting as a satellite fund around a diversified core, which may be passive or active. So that core satellite type approach, really is what we see there. And each fund is going to have their own objectives. For us, it's about finding those opportunities in that transition towards environmental sustainability. So we view that as a long-term thematic approach, and therefore, the fund would really be used similar to other thematic funds. And I know I think your webinar tomorrow is talking about new economy and thematic options. So we probably could have put a spot on that one as well, Toby. So these are strategies that are investing in long-term megatrends. So healthcare, demographics, tech, AI. We're sustainability. That's our thematic. So certainly that could play a place in have a place in a broad portfolio. For the responsible investment portfolios, or ESG, if we want to bring that term back in again, it makes sense for what we're doing to potentially sit at the core of the portfolio. But again, it depends on the portfolio objectives, style exposures, sector exposures, region exposures, risk budgets, all these sorts of things. So there's no one size fits all.
And I guess from my side, looking into this and looking at it from a portfolio perspective, building portfolios, whether it be ESG or responsible or not, it's about giving that strong process to if those mega trends are something you really want to hit, you really want to focus on understanding what the manager is doing and how does that fitting into that whole portfolio discussion, I think is probably always the key from a portfolio construction perspective. What I might sort of do is, Dianna, there was a question specifically just for yourself. Can you provide a bit more detail in what companies will have to report and might mean for fund, what it might mean for funds management? So just a little bit more on that what does the reporting looks like and a little bit more detail.
Okay. Thanks. It's a great question, and I'm assuming it relates to the mandatory climate reporting that kicks in this year. So the Australian Accounting Standards Board issued their Australian Sustainability Standards, and this was based on the international version, the ISSB version, which was then subsequently had been developed from the Task Force on Climate-Related Financial Disclosures, or the TCFD. So it's already a framework that has already been in place for some time, because the TCFD has been around for some time, and it's really based on 4 pillars for disclosure. The first is around governance, the second is on strategy, the third is on risk management, and the fourth is on metrics and targets. And I guess the part where people are most interested in is, what are the metrics and targets that companies are required to report on. So this will include things such as greenhouse gas emissions, scope 1, 2, and 3, transition risks and physical risks. So we talked a little bit about physical risks today, but they need to report the dollar amount and percentage of assets or business activities that are vulnerable to physical risks, and the same for transition risk. It also requires you to look at what your climate-related opportunities are, whether you have an internal carbon pricing, what are the remuneration, the proportion of executive management remuneration that might be linked to climate related considerations, for example. So these are the types of metrics that are required. And I think in terms of, I saw that the question also asked, what might mean for funds management. The standards really to encourage or require disclosure of material information around climate-related risks and opportunities that could affect a company's cash flows, their access to finance and cost of capital over the short, medium and long term. And that links back to the financial aspect, makes it very relevant for funds management, right? So if there's a company's exposed to a physical risk or a transition risk that can impact their cash flow or can impact the ability for them to access capital because they're going to have stranded assets in the future, then that's very relevant for investment managers to understand what those risks are and also what the potential opportunities are for the companies with climate change. So really it's for funds management by mandating a standardized regulatory reporting, it provides consistent, comparable information for investors to assess the impact of climate change on companies, and then that enables investors to allocate, funds more efficiently and in a more informed way.
And just off the back of that, just a question from my viewpoint around this is, what are some of the biggest, and we'll just sort of continue on, and Mark, I'll come to you around this one from a funds perspective, but what are some of the biggest gaps or inconsistencies in ESG data today? And should advisors interpret these limitations, or what are your viewpoints on that from a data sort of perspective?
I think sometimes I think things such as climate, physical risk, for example. I mean, there's certain scenarios such as the IPCC. They have 4 different climate scenarios. There's a low scenario, a medium, high, and high. And high is if we don't do anything about climate change and we get to really super high temperatures by the end of this decade, and low is if we're really putting out all actions to reduce climate change in line with the Paris Agreement. So these types of scenarios are already in place. It's been developed, and most of the data providers in the market will use the same. So there's some consistency around that. I think where some inconsistencies will arise will be around ESG scores type data, as I mentioned, just because E, S, and G individually comprise so many different factors. And so I think that's where advisors maybe need to just really understand the methodology, really understand for the data provider that they're using what really goes into the ESG scores. But a lot of the other data, such as, carbon calculations, that's pretty much standard. A lot of companies have been doing it for a long time. Around carbon, I guess the main area that might be still needs to be developed is just around the private companies, because a lot of that's still at the moment modeled, because a lot of private companies aren't yet disclosing or calculating their greenhouse gas emissions.
Oh, thank you. And Mark, from your perspective, just looking at, can advisors differentiate between, I guess, looking at from a research house perspective, what is reported on certain strategies like yourselves from a responsible how you're targeting? Has the data improved, and can, I guess, clients meaningfully distinguish between different sort of strategies like yourselves and maybe a strategy that might not be up to scratch, similar to how you sort of approach things from a process perspective? Do you think the data in general from a funds management perspective and research perspective has changed over time?
Yeah, look, I think there's a couple of different platforms that do provide reasonable amount of information on what's underneath the bonnet of some of these strategies. But again, I think going back to my earlier point, I still think that there's a lot of confusion around what a fund does. So we see managed account model portfolios that have a sustainable or responsible investment badge on them. And we look at some of the funds that have been chosen in those portfolios and really scratch our head as to how that justification was made. And some of these are coming out of highly respected research companies, and no disrespect to them, but I still think that there's a long way to go when it comes to understanding how certain funds are actually investing. So for an advisor or investor, I still point back to you need to engage with the fund manager. You need to look at what reporting the fund manager is able to provide in relation to what they do inside their portfolio, to make sure it meets those objectives. So, the reporting, the scoring is useful, but I would urge people to dig a little bit further to make sure that they're getting what it says on the tin. I think we've seen. I'm not going to go into the greenwashing issues, but we've seen greenwashing issues over the last few years, and certainly need to be careful that you're not falling into that trap.
I think you raise a good question, a good answer in terms of when we're looking at this from an advisor perspective, also is how strategies, what type of transparency is being provided in the underlying. If this is something that is really something that you need to hit for a client, what does the reporting look like from the manager or from the data provider? How is that reporting sort of linking to your portfolio, and how are you communicating that? I think that's probably, to be honest, Mark, a huge aspect. The reporting has changed, in your view, quite a bit over the number of years as well, and that's what we've noticed.
Yeah, and look, if you're not getting the information that you need from the fund manager, maybe that fund manager is not the right fund.
Just to sort of, I guess, more of a question that's always up or always discussed about is, does ESG or responsible mean having or accepting a lower level of portfolio performance? I know it's always something that always gets asked by some advisors, I think, from a perspective of, okay, it might be something new, or they have one client that might not necessarily, that sort of comes in and they're looking at this space for the first time and they've had predisposed views. What would just opening up from the panel, what everyone would sort of look in or think about that? I think from my example is, if it's a well-established portfolio with strong managers, strong underlying investments, with a process that's clear, and I guess how you've defined responsible investing. Like, obviously, we look at impact and exclusion, and not being too cyclical, and how that portfolio construction is designed. Those portfolios, maybe the ride is different, but you get there in the end. Mark, Dianna, does anyone want to sort of start that one off in terms of your viewpoints?
Yeah, I'm happy to kick off. As you said, Daniel, it's just such a question that always comes up. So I've actually prepared some slides. So Toby, if you don't mind just putting up a slide to just illustrate this. But firstly, a disclaimer, like the information on this slide is for illustrative purposes only, and it's not a recommendation or advice, because I'm not an advisor or investment professional. So this is just really factual information based on our indices. So generally, there has been an expectation that having a sustainability focus in indices or portfolios means giving up returns. But you can see in this chart, this really illustrates the year-to-date, 1 year, 3, 5, and 10 years annualized returns of the S&P ASX 200 index, the parent index, as well as the ESG and the carbon efficient index of the S&P ASX 200, which I talked about earlier. And you can see that, the returns of the sustainability indices have been pretty much aligned, and if not slightly better than the parent index. So in fact, it does show that you haven't had to give up returns to invest sustainably. And I think what helps is that when constructing our sustainability indices, we do try to keep the sector allocations quite similar to the underlying parent index. So if you move to the next slide, please, Toby. So the question is, the returns are fairly similar, but does that mean a higher risk? So in the bottom half of this table, you can see the risk-adjusted returns across 3, 5, and 10 years. You can see that the carbon efficient index illustrates quite similar risk-adjusted returns to the underlying S&P ASX 200 index, and the ESG index has slightly improved risk-adjusted returns. So you can conclude from this that in general, risk has also not been higher to invest sustainably. I've got a few other metrics here as well. So you can see in terms of constituents, the ESG index is, broadly half of the parent index. It's got 101 constituents, and the carbon efficient index has 183. If you look at the carbon metrics, which we have carbon to value, which is metric tons of carbon dioxide equivalent over $1 million invested, and carbon to revenue, which is metric tons of carbon dioxide equivalent over $1 million of revenue. For the carbon efficient index, as we expect, because we're investing in lower carbon companies, all these metrics are lower than the S&P ASX 200 index. For the ESG index, it's lower except the weighted average carbon intensity. And, I guess the reason for this is our ESG indices are designed to achieve higher ESG scores compared to their underlying parent benchmark. But as we discussed earlier, ESG scores aggregate a whole number of metrics across E, S, and G topics. And so, even within the environmental pillar, there are various criteria that aren't directly linked to carbon reduction. So in essence, we wouldn't always expect that the ESG index would have a lower weighted average carbon intensity compared to the underlying parent index. Just see if Mark has any comments on this.
Yeah, thanks, Dianna. Yeah, look, if simplistically, if we didn't think that our sustainable investment strategy wasn't going to provide, meaningful value creation for investors, we wouldn't be doing it. Intuitively, companies operating in a more sustainable business or industry, you expect will be beneficiaries of long-term tailwinds. So there's certainly some positive aspects that are helping these businesses. But like anything, an investor shouldn't rush blindly into this sector and expect to receive great returns. Just like any investment, there's going to be winners and losers. And for us, we're an active manager. We're undertaking fundamental analysis on each business to understand, how much competition do they have? What are the barriers to entry, regulatory risks, these sorts of things. So it's no different. So investing in this space, it's not about ideology. The investment thesis must also stack up. So again, there was a chart up a minute ago just showing the return of our fund. And again, the disclaimer there, that doesn't guarantee the future returns, but over the last nine years, we have been able to provide positive alpha against MSCI equity.
And is the demand for portfolios built in this manner, I think, from both your sides, growing or shrinking? I think from our perspective, it's been growing, and advisors do have clients that are asking this, but also there are specific clients that you have around that need this as part of their whole solution. Mark, Dianna, obviously, a quick question on this one, but is it growing in your views in terms of all the complexity around it?
Sorry, yeah, thanks, Dan. Look, there's ebb and flow in these strategies depending on what's going on in the world at the time. So I think the confusion probably in recent years hasn't helped, and the greenwashing issues has seen a little bit of a softening more broadly. But I think investor awareness of the issues is absolutely growing. And going back to that the point that Dianna made earlier, the RIA research that 88% of Australians expect their super investment to be invested responsibly or ethically. So I think there's an opportunity for advisors there to engage with their clients on this issue. I'm pretty certain, I could be wrong, but I'm pretty certain that advisors are not having these conversations with 88% of their clients. So there may actually be an unmet objective that can be addressed in the advice process. And I think as the younger demographic starts moving through the investing life cycle, we'd see that demand to shift higher. And as I said before, there's probably going to be a range of new funds and strategies that will actually come to market to suit investors going forward. So yeah, there is demand. As I said, just in the short term, it can ebb and flow, but long-term structural demand is growing.
Is there any last sort of comments given time around that?
No, I think Mark covered it, and I totally agree with his comments. I do believe that the younger demographic is going to be driving this. They just are more aware and have more interest, and it's going to affect their lifetime more than some of ours. So I do think over time it will grow. But the other factor I think is that, over time as well, sustainability will just become more and more embedded within the investment approach of funds. So you might not have necessarily so many specific sustainability funds, but it's just that, all the investment team and analysts will have to just consider it because it's a risk. And, and so it will just become more embedded into the investment approach.
Thank you, Dianna, Mark, and again, I guess for advisors, I think what data and how you're getting that data for the underlying funds, or whether it be equities, is very, very important. And then some of the transparency that comes from your managers and needs to be high quality. Toby, I might pass it on to you to sort of close it off.
Yep. Thank you very much, Daniel. Mark, Dianna, thank you very much for your presentations that have just highlighted for me some of the complexities that this gives rise to in a portfolio construction context. And I think one of the key issues will turn out to be the fact that my responsibility is not your my responsible is not your responsible, and that advisors will have to grapple with clients who need portfolios that address their specific investment objectives, but also their specific value objectives as well. And the ability to both build portfolios and to understand the composition of the portfolios that they're recommending will be an increasing part of the role of the advisor. So, Daniel, thanks for your work again today, and we'll look forward to seeing you tomorrow. To Dianna and Mark, thank you very much. So just a quick reminder of things that are coming up tomorrow. We'll be talking about sort of a related issue, perhaps, sort of investing in thematics and alternatives with a new economy approach. For those of you who are considering the awards, I'd encourage you to participate and to enter by the 23rd. And we'll look forward to seeing you in person in July. So thanks very much for your time today, and look forward to seeing you all again tomorrow. Thanks.
Thank you.
You.
Thanks, Toby.